Good morning, everyone. Welcome to Daily Rates Live with the Mortgage Calculator. Today, we're going to talk about first time home buyer loans after we go through our live rates here. So, give us just a moment to go live on all the different platforms. We got the chat up on the screen there. Feel free to drop a comment there in the chat as you tune in. Definitely appreciate it. We'll get started here in just a moment. Hope everybody had a great weekend. Is ready to get back to it here. All right, it looks like we are live on all the different platforms, so we'll go ahead and get it started here. What we'll do is we'll take the chat off the screen for now, but go ahead and keep dropping comments there in the chat as you tune in. Also drop any questions you have in the chat as we go through the presentation here today. All right, so welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We're a lender that specializes in non-QM loans. And what we do every weekday at 11 a.m. Eastern on this show is go through our live rates, and then we do a deep dive into a different loan topic. And today's loan type or topic is going to be first-time home buyer loans. So Jose will go through some different options for first-time home buyers. But before we do that, we'll do what we do every morning, which is look at our live rates. So Nick, if you're ready, let's go ahead and pull up our rates today and see what the market is looking like this morning.
All right, so we should have lots of news today. Unfortunately, the rates haven't changed too much. So we will pull up all of our different programs. It is just after 11 a.m. on July 9th. So all of our standard programs have their initial rates issued here. We will compare the APRs across a standard scenario. If you'd like a full breakdown and itemized loan estimate of all the fees that go into the APR, please get with our team members. We have over 300 loan officers that would be happy to help you out. For the demos today, we will set up a standard single-family home, a 80% loan to value by setting up a $500,000 purchase price, a $400,000 loan amount, that's 20% down, and we will set everything to a 760 estimated credit score and an estimated 40% debt to income ratio. So let me go ahead and share my screen. And we'll look at today's rates. So first up is our 30-year fixed conventional for a primary home. This is what most people think of when they think of a standard mortgage loan. Rates today come in at 6.49, APR 6.802, pretty much exactly the same as yesterday, not much movement yet. And if for any reason our customer doesn't qualify for a conventional option, the next option we typically want to present is an FHA option. FHA allows more leniency on credit issues, as well as a much higher debt to income ratio, but it does require upfront and yearly mortgage insurance. Rates come in today 5.75 and a final APR with all of the fees included 6.711. So notice if our customer qualifies for both, they may consider FHA if they're willing to do the mortgage insurance. And our customers that need to use FHA, definitely very comparable APR here across the programs. And our eligible vets and active service members can use our VA programs. So VA programs are only for those that are eligible. But if you are, these are amazing rates as low as 5.875, and the APR with all of the fees come out to 6.195. So when we're comparing across programs, obviously our eligible vets and active service members would be definitely their benefit to use this program. It beats FHA and conventional substantially. And moving on to our last standard option here for our government programs, we have our USDA programs. USDA is only for USDA eligible areas, typically the rural areas of the country. And for our borrowers and properties that are eligible for USDA, these options come in at 5.75 today, final APR 6.512 with all of the fees. So notice if our customers shopping in these areas, they typically be comparing to an FHA, which USDA beats by a little bit there, and it also beats conventional by a little bit. So for those that are eligible, it's a great option. Now, if our customer doesn't qualify for any of these standard agency or government programs, most other banks or lenders will have to deny that customer, but we have over 5,000 additional options. First up is our 30-year fixed non-QM alt doc option for a primary home. So if our borrower doesn't qualify using standard tax returns, etc., for a conventional program and needs to use alternative docs such as bank statements, 1099, P&L programs, asset-related programs, all kinds of different options we have. This first option here is most likely a bank statement or similar. Rates come in today at 6.875. Final APR 7.19 with all of the fees included. And if we compare that to conventional, it's very comparable within about a half a point. So definitely a great option for our borrowers that need a little bit of extra help there. And our investment properties, definitely a lot of flexibility for those. First up is our non-QM alt doc. So again, bank statement are similar for an investment property. Rates come in at 7.25%. Final APR, 7.589 there. So we'll compare that to our other investment options. There are no government programs that work for the investment property, so no USDA, FHA, or VA options, but we do have our conventional agency option here for investment properties. 7.25 rate, final APR 7.611. So notice today, AltDoc is beating it by a touch. I believe yesterday it was flip-flop. They tend to flip-flop a little bit there. But always recommend our investors check out our favorite programs, our DSCR. So DSCR stands for debt service coverage ratio. No income needed, no employment info needed. We simply use the estimated rents from the appraisal to determine a DSCR ratio. If the estimated rents can cover the expenses, aka the property cash flows, that's a ratio of 1 or higher, which is typically preferred. For the demo CR, I use the ratio of 1.5 so that all the programs pop up. And first up here is our 3-year prepayment penalty option, which is pretty standard for these programs. Rates come in at 6.999, final APR 7.341. Notice that beats conventional, absolutely amazing. And we have our options with a 5-year prepay. Not all programs allow it, but some do. Rates come in today at 6.75, final APR 7.072. Again, beating conventional substantially. And the final option here is a DSCR with no prepayment penalty. Some states don't allow it, and some investors don't want it. No problem. We have this option here, rates as low as 7.5, final APR 7.953. Notice it's a touch higher than conventional in this case, but still a great option for our investors. And our investors that are looking to lower the rates, definitely check out the prepayment penalty options. And the final 2 things to cover here are our second mortgage options. So 30-year fixed second mortgage is a non-QM product. This is a new product that has come out to help our customers that may have a low rate first mortgage and don't want to touch that, but still need some cash out. HELOCs are variable rate products and a little more restrictive. So we have our 30-year fixed second mortgage non-QM product for a primary home. We can still get cash out for 8.125%. Final APR 8.278, typically preferable to a HELOC or adjustable. And it's also non-QM, so we can use bank statements or similar. We can also use the same program for investment properties. So for our investors looking for a little cash out without wanting to touch the first mortgage, rates as low as 9.875 and a final APR 10.154 to get cash out of the investment property without touching that first mortgage. And again, not a lot of HELOC options for investment properties, so great option there. Let's switch it up back to our topic for today. So when we do our live pricing demo, we don't get to do all the specifics. We go over different property types, but today we're going to be talking about borrower types. So there are some unique programs that allow some exceptions. Jose will go over here for our first time buyers. That are incentives, obviously, to foster home ownership. All the different agencies of all the different types have that one goal in mind: get more people into homes. So there's all kinds of different twists we can do to our loan products when we do have a true first-time home buyer. Also, first-time home buyer might not be what you think it is, right, Jose? So why don't we first define what that is, and then we'll talk about the different tips and tricks.
I'm currently frozen. Give me a minute.
We can hear you.
Okay. So let me talk until my screen unfreezes. Let me define a little bit about what we're talking about, because that's the main reason that I wanted to have this first-time home buyer podcast today, because like you just mentioned, Nick, there is a lot of misconceptions about what a first-time home buyer is and about what are the possibilities for a first-time home buyer. So first, we're going to talk about the literal translation of what a first-time home buyer is a borrower who has not owned a property in their name in the last 3 years. That includes if you co-signed for somebody, if you just happen to be on title for whatever reason, but you're not responsible for the loan on that particular property, you're still a property owner and you're not a first-time buyer. So that's the first thing that I want to clarify. However, I also want to clarify that a lot of the best options are not just open to first-time buyers, but to primary home homeowners, right? The primary occupant of the home, right? That's the case, for example, with our USDA option, which is 100% financing, with our FHA option, which is 96.5% financing, in other words, 3.5% down. Many people have the misconception that FHA loans are for first-time home buyers, and they're actually not. It's just that an FHA loan is for primary homeowners only, right? And for you to get an FHA loan when owning another home, there are additional restrictions and requirements that must be met, which is probably the reason why most people think that FHA loans are for first-time home buyers only, because actually the only loan that's for first-time home buyers only is the conventional 3% down loan option. However, I will state there's another however there. There are 3% down conventional loan options with lower interest rates and lower mortgage insurance that are not for first-time home buyers only. It is the affordable option, right? The conventional affordable option that, as long as the income is at 80% or below the area median income, the HUD area median income, then you would qualify for that program. There are two exceptions to that allow greater borrowing, and that is if the property is located in a low to moderate income census tract, or if the property is in a minority census tract. So you can access the Fannie Mae or Freddie Mac geocoder lookup link there, and you pop in the property address, and it lets you know if that, what is the HUD median income for that area, what is it, the 80% amount, and most importantly, it also lets you know if it's in a special designated area. And I believe also disaster areas are also another special category. So let me share the options I have with you today so that I can enlighten all of our borrowers out there with all of the great low down payment and low interest rate, or should I say reduced interest rate and reduced mortgage insurance options. So our first option here is our true first-time home buyer conventional purchase with 3% down. Now, this is the option you would pick if you wanted the lowest down payment conventional loan with the lowest rate and the lowest mortgage. Excuse me, with the lowest down payment, but this is not the lowest rate or lowest mortgage insurance. That's the affordable option. So right here, what I did want to note here is notice that I'm showing some options with lender credits as well, because our 3% down buyer may have a need for some closing cost assistance that you can build into the rate, because we know how tough it is out there in this tight inventory. It's not, depending on the market that you're in, it's not very easy to request seller contribution, especially if you have multiple offers on a property. So in this case here, we can get as much as $2,425 in lender credit to the borrower's closing costs that can be applied, to the borrower's closing costs. That would be at a 7.49% rate. Right? Then our par rate at zero costs for the rate is 7.124. And we can buy that down all the way to 6.375 at a cost of 2.125. So now this is our true conventional loan, 3% down, first-time home buyer, and this one does have a mortgage insurance of $113 a month. Now, our next option is our affordable option that I was mentioning, still 3% down. Now, this is not just restricted to first-time home buyers, because this is an affordable option. So this loan actually allows you to own a current residence and still be able to finance with this option, because again, like I mentioned, it is an affordable option, meaning that, like I just mentioned, you have to be at 80% or less of the HUD median income for the area, unless it is in a designated area. Low to moderate income, minority, or disaster. So here, now look at how much better the rates are. Here, 6.99 offers a lender credit of 0.75. And then you can buy that down all the way to 5.99 at a cost of 2.5. And if we go back over to our prior scenario, right, this one, 7.49 offering a half a point lender credit, and this one, 6.875 offering the same half a point lender credit. So we're talking about more than half, about points, almost around 0.6%, 0.6% lower in rate for the same scenario, other than being the affordable option. Oh, and the mortgage insurance is $98. I know when you have the really high credit score borrowers limit to the amount in benefit, but definitely great option there. This one has a 25% MI coverage, hence the $98 a month MI. So you'd be looking at a substantial benefit in the payment. For example, if we were choosing that half a point credit option, this one is $31.86 versus the other one $33.88, right? So that's pretty good difference there, about a couple $100 plus the $15, $16 for the MI. So it's $220 approximately in lower payment for our affordable option. So it definitely meets the mark. Now, again, misconceptions about first-time home buyer requirements and down payment assistance. Now, there are down payment assistance options out there that may require the borrower to be a first-time home buyer, but those tend to be the localized down payment assistance options, which are much more restrictive, are dependent on funding. So you may be approved by the program, and then you may have to wait for funding to be available so you can actually close on a home. So the great news is that our down payment assistance option is not restricted to first-time home buyers. It is for primary residents only. Now, this is the repayable option with a minimum down payment of, minimum credit score of 660. Now, there's a repayable option and the forgivable option. The repayable option, as you would figure, has a lower interest rate and a lower cost. And the down payment assistance is offered as a second mortgage with a 30-year amortization, 9.99% interest rate, and most importantly, a 10-year balloon term. That means that after 10 years, the loan has to be paid off, either through physically paying it off or refinancing the whole first and second mortgage into a new loan. Chances are that in a 10-year period, that loan probably would have been refinanced into a conventional loan with no mortgage insurance. When the rates drop, the main thing is to get into the home, right? So the repayable option does have a much lower interest rate and cost. So you can see right here, our repayable option at 7.625 is almost at par. Now that's a very important note, because most of the down payment options that you're going to see out there that are 3.5% down payment assistance and repayable have a cost for the same rate of like 3.5 points. That's not doable unless you have seller credit to pay those points, because 3.5 points is probably not going to pass a compliance test. You would be close. You would have to get two bona fide discount points to pass your compliance test at that cost. But here, with our option, no worries, 7.625, lowest cost option, 0.375 points. and you can buy that down all the way to 6.875 at a cost of 2.375 points. And ideally here, the perfect scenario would be to try to negotiate, on top of getting the down payment assistance, some seller credit to hopefully pay some of this loan discount if the borrower wanted to go to 6.875. But no worries, if no seller credit is available, you can still get 7.625 at almost par and really maximize the down payment assistance. Because if not, what would be the purpose of getting 3.5% in down payment assistance and then you have a cost of 3.5 points? That just doesn't make sense. Not doable. So now, to give a little bit of context to the situation, our forgivable down payment assistance. Now, this is the aphrodisiac, right? This is the one that draws them in, the quote unquote free money, right? Now, this is a second mortgage that does not have any payment requirement, no interest accruing, nothing. It's just a second mortgage lien for the amount of the down payment assistance. The great news is that after 60 payments are made on the first mortgage, as long as you are still current on that first mortgage and obviously still live in the home as your primary residence, then this second mortgage can be forgiven. That's the key. But you do see that there is a cost now. 8.75 at a cost of 3/4 of a point is pretty good, right? You're going to get a good benefit there, 2.75% net to you. And then you can buy that down all the way to 7.625 at a cost of 2.125. Not bad. The other one, I think, had a cost of what, 0.75, was it? No, 0.375, which means that this costs you about 1.75 points more than the repayable, and the interest rate is higher. So obviously choosing repayable or forgivable may also depend on, does the borrower qualify for this higher payment of 38.62, right? Or do they only qualify for the payment at 7.625 of 34.75, in which case do they want to go with this option at 2.125 points, or do they want to go with the repayable option costing 0.375, right? So points to consider there, very important. We have a USDA. Now, this one is the mind blower, right? Because USDA doesn't have a down payment requirement, but we have 3.5% down payment assistance for USDA, which can be applied to the closing costs. So depending on what part of the country that you're in, what your tax expenses for that property and the cost of the insurance, right? You could almost do this as a cashless transaction, having that 3.5% cover your closing costs, because USDA does not have a down payment requirement. So 8.7, now the cost a little bit higher than the FHA option, obviously, because it's 100% LTV. So 8.75 has a cost of 1.25 points for this forgivable option. Remember, this is a forgivable option. The repayable option is not offered on the USDA, only the forgivable option. And you can buy it down all the way to 7.75% at a cost of 2.5 points. Now, to add context to what I was mentioning about repayable, forgivable, and DPA, there are situations where the borrower may not need the full amount, right? And this is where you really have to start doing the math on the net benefit. I guess we'd call that a cost benefit analysis to your down payment assistance for your first-time home buyer who's counting on you, right, to give them that concierge service, walk them through the whole deal. Well, here you will note 7.125 on our regular FHA loan has a 1% lender credit. That's $4,909 in some cases, depending what part of the country you're in and your insurance. Heck, I was doing a loan today where the insurance is $650 $15 a year, and the taxes are $1,300. So that's going to have low closing costs. So here we're looking at 1% lender credit could cover half your down payment assistance, right? At 7.125. And over here in our, let's look at our repayable option, right? 7.125 is costing 1.5. That's a swing of 2.5 points difference in pricing. So what's the real benefit here to this option is 1 point. 1 point. So let's go back here. Okay. Don't know what happened there to my system here, but this is our USDA, and this is our FHA, right? So 7.125 has a lender credit of 1 point, and you can buy that down all the way to 5.75. So again, it could be a case of, does your borrower qualify for the higher interest rate, or do they need this 5.75% interest rate to qualify? And actually, that was our last option, which was I wanted to bring it all into context there, is our 96.5% FHA, because it's always a point of contention of, is there a benefit to DPA, or can we get by with just getting lender credit? So I showed you today FHA down payment assistance, USDA down payment assistance, Home Possible, regular first-time home buyer, and regular FHA.
All right. Thank you, Jose. Let's see here. Looks like we do have a couple of questions. We can go ahead and let's bring one up on the screen here. Let's see. The question is FHA first-time DPAs for 1 to 4 unit primary homes. This includes 1 to 4 family primary home structure.
No, there are restrictions there. For the FHA down payment assistance, it is limited to 1 and 2 unit properties only. And there is a loan level price adjustment for the 2 unit property. I guess we call that the duplex. It is possible also for manufactured homes, but there is also a loan level price adjustment if you have a manufactured home for the DPA.
All right. USDA is for 1 family only, is the other question.
That is correct. USDA is pretty strict about what they want. 1 unit properties only for USDA. But the great news is USDA does offer financing on manufactured homes as well, right? And manufactured homes tend to be pretty prevalent in those more spread out areas. So do look for manufactured home opportunities in the USDA areas.
All right. Looks like we had a question come in from Instagram as well. The question was, when I purchased my home, I was a first-time home buyer. My wife was not on the purchase. Is she still a first-time home buyer now because she's not on my current?
Well, that what it boils down to is what you're saying is your wife was not on the loan application, right? She was not a borrower. But like I mentioned initially when I was talking about first-time home borrowers or buyers, if you are on title, then you would not be considered a first-time home buyer. So you would really need to look at the vesting on your property, look at your title insurance policy, or look at your warranty deed and see how it's worded. It could be worded you as a married man, or it could be worded you and your wife. If she's on the title, then she would not be considered a first-time home buyer because it's not first-time home borrower, right? It's first-time home buyer.
All right. Looks like that's all the questions. Thank you for the questions here today. Remember, we do this at 11 a.m. Eastern every weekday where we go through the live rates and then do a deep dive into a different topic. So we'll be back tomorrow with a new topic. Appreciate everybody tuning in and thank you for the questions. We'll see you tomorrow, 11 a.m. Eastern, for the next episode.